Okay, I think we'll go ahead and get started this afternoon. I want to thank everybody for taking time to join us for this workshop regarding the National Flood Insurance Program. My name's Tom Fayram. I'm the Deputy Public Works Director for the County of Santa Barbara. And also joining us today from Congresswoman Lois Capps' office is Rachel Condor. She's here joining us as well. We annually at the county host what's called Flood Awareness Week, and if you came in through the lobby downstairs or in Santa Maria in the Government Center, you'll see a display that is meant to remind everybody as we head into winter that regardless of the weather patterns, for instance, if you've driven by Lake Cachuma or any of our other reservoirs looking rather low these days, that the flood threat is a real threat in any given year. And we've seen that in the throes of a drought, all of a sudden a big storm can cause all sorts of problems. So we host this for over 10 years now, Flood Awareness Week, and this year we wanted to add this workshop regarding the National Flood Insurance Program because there has been some significant changes to the flood insurance program. Now, the flood insurance program is a federal program, and the requirements that come out of that program are as approved by the Congress and signed by the President. And recently, there was a extension, I guess it was an extension to the National Flood Insurance Program, but it was called the Bigger Waters Act, and it made some significant changes to how flood insurance is looked at by FEMA and the federal government. So we're very delighted to have some representatives from FEMA. We have Ed Curtis from the Oakland office and Edie Lohman, and where did Patricia go? Okay. Patricia Rippey is from FEMA as well. And what we're going to do today is we're going to have our FEMA reps give a presentation. I think Ed's going to start first, and then Edie will have a PowerPoint presentation. And then we'll allow time for questions. We want to hear your questions, and then of course afterwards, our staff and FEMA will be around if you need to talk some more. I will also mention that during this week of Flood Awareness Week and every week, you can do a flood hazard determination to see if a particular property is in the FEMA designated floodplain. That's normally a $40 charge that the county charges. This week it's free, so if you want to have that process done, we can do that for you this week. So catch Mike or Nick after the meeting here, and they'll get you set up. I also want to mention for anybody in the audience that I haven't talked to and up in Santa Maria is that many of the local government officials are involved in what's a certified floodplain manager. And if you are a CFM, you get continuing education credits for participating in this workshop. I believe Mike has the forms that you would just have to fill out and submit to the Association of State Floodplain Managers office in Madison, Wisconsin, right? Go Badgers, Nick, right? Yeah, right. He actually went to Purdue. So without any further ado, I'll ask Ed Curtis to come up, and he'll give you just an overview of the National Flood Insurance Program, how the flood maps are created. And then I think the meat of the matter is we want to learn, what bigger waters means to people that have flood insurance policies. So Ed Curtis from FEMA.
Thank you, Tom. Hi, everybody. As Tom said, I'm Ed Curtis. I'm with FEMA Region 9 out of our office in Oakland, California. That's our headquarters for our region. And just for your information, we cover, out of that regional office, we cover the states of California, Nevada, Arizona, Hawaii, and all the Pacific Island territories. So I'm one of a group of engineers, about 4 engineers that have that area sort of geographically divided up as far as being responsible for maintaining and updating the FEMA flood insurance rate maps for that area. So I work, one of the areas I work with is the County of Santa Barbara. Briefly, the National Flood Insurance Program is a federal program that's been in effect since dating back, its origins go back to the 1960s. Before FEMA was actually created as an agency, at that time, the responsibility for the program was under the responsibility of HUD, but it transferred over to FEMA when FEMA was created as an agency. Its origins sort of go back to a period back in the 50s and 60s when there were some very devastating floods in the Mississippi River basin and some of those major rivers in the middle of the country. At that time, the only insurance available was through private insurers. Those insurers found that it was not economically feasible for them to try to insure the peril of flood because there was actuarially for them it just wasn't a paying proposition. So they were getting out of the business of providing flood insurance. At that time, Congress moved in basically and created the National Flood Insurance Program as a vehicle for both residential and non-residential owners of structures to purchase insurance to provide coverage against flood for both structures and contents. It took a while to sort of evolve, but it really has three components that go into the flood insurance program itself. One is obviously the insurance, the actual policies that are written, and Edie Lohman, who's here, is going to take most of this presentation as an opportunity to bring you up to date on the recent changes to the flood insurance program that, as far as the policies are concerned. But the other two components have to do with, one is the actual flood insurance rate maps themselves, and then the third component would be the local what we call flood damage prevention ordinances. Sometimes they have other names, but communities actually join the National Flood Insurance Program. Most communities in the country, obviously the communities in Santa Barbara County have all joined the National Flood Insurance Program. One of the steps they took in joining the program was to adopt a local flood damage prevention ordinance, which means that their ordinance matches up with some federal requirements that are basically the minimum requirements for how communities regulate development in high-risk flood zones. You'll hear another term we use is special flood hazard areas. And there also, we have other terms, but the one people are most familiar with probably is the 100-year floodplain, or the areas that could be inundated by a flood. The chance of them being inundated in any given year is 1%, which translates to a 100-year recurrence interval. So in order for anyone to initiate some kind of an insurance program, you have to know what the risk is that you're insuring against. And in order to insure against flood, we first had to create a set of nationwide flood insurance rate maps that identify and create the boundaries for the high-risk flood zones versus the lower moderate-risk flood zones. So now that this program is under FEMA's area of responsibility, FEMA is required for maintaining and updating a set of nationwide flood maps, including maps for all the states in our region, which is quite a significant undertaking. We get an annual budget from Congress that allows us to sort of on a priority basis update information. The maps were all initially created back usually in the mid to late 70s. All of the individual cities and the counties received flood insurance rate map panels for the areas within their jurisdictions. So there was a wave of initial flood insurance rate maps that were created back under the HUD administration. FEMA has picked up that responsibility now. As you can imagine, that was a pretty massive undertaking initially to create maps for all the high-risk flood zones in the country. And at that time, there was an effort to use really the best available information on hand from various sources, various other agencies that had identified flood-prone areas. Individual communities had done some of their own studies. FEMA took all of that information and created those initial set of maps. As we've moved forward, as we've gotten better information, as the technology has improved to predict and analyze what a 100-year flood or a 1% annual chance flood would look like in any particular watershed or river system. And we've developed better computer models. A lot of our computer models were developed by the Corps of Engineers. We've been able to do new modeling, study areas that weren't previously identified on our original maps, and come back and do periodic updates and modifications, as well as receive information and updates that are being provided typically by developers as new areas are developed. Usually if they're in areas that are previously identified as special flood hazard areas on a FEMA map, there's a cooperative effort between the community and FEMA to make sure that the proposed development is being, the effect of that development on the floodplain is being analyzed and provided to FEMA so that we can update our information on our map. Typically what that process, the way that process works, because that's normally sort of the mode that we're in now, since the maps have been in existence for quite a few years, we're in the process of doing updates and using information that's being submitted either by communities or by developers. They will typically submit a study of the effect of their development on the 100-year floodplain that's shown on the existing map. FEMA will review that result and make sure that the study was done in compliance with our regulations and our guidelines and specifications for a flood study, for a 100-year flood study. When we've agreed to accept that study, we will issue a revision to the map. Usually it's in the form of a letter. We call it a letter of map revision. In the old days, everything was done on paper. Obviously, I talk about maps, people think about paper maps. So until about 5 or 6 years ago, all of our mapping was done on paper, and when we made a revision, we sent out a paper letter with a paper 8.5 by 11 or a piece of the map that's been revised, and it's kind of up to the community or to tape that piece of paper in on their existing map. Very kind of primitive process. But several years ago, Congress funded FEMA to modernize our maps and to bring them sort of into the digital age, if you will. So we now essentially have, certainly for our region, have replaced really all of those paper maps with digital data. And we use, some of you are familiar with Geographic Information Systems, GIS data. It allows mapping information from various sources to be combined and used to compare information so we can compare our flood risk with, or at least the communities compare the flood risk information from our maps with other risk information from other sources, or with parcel data that they have and that sort of thing. So without going into too much more detail, that's generally what our mapping process is specifically for Santa Barbara County. FEMA completed that map modernization for the county actually in December of last year. We issued a complete new set of flood insurance rate maps, digital maps, for Santa Barbara County that we use the term they went effective. They became effective for flood insurance rating purposes and for the communities to regulate development in those high-risk flood zones. They went effective in December of last year. We don't have any current plans to do a future countywide update like that. We not expect is that going down the road in the future that we'll be updating based more on watersheds, areas of the county that are being drained by one particular river or stream. For instance, Santa Maria River, Santa Ynez River, some of the other rivers like that may or may not need to be updated in the future. We would update the maps for those particular panels. Let's see, what else did I want to mention? I think that's Oh, I'm sorry. There's one. The other thing I wanted to mention is, obviously, there's also a flood risk for those properties along the coast. And initially, when FEMA created, or HUD created the initial flood insurance rate maps, they also created maps all along the California coast using the technology that was available back in the early 80s. That technology and methodology and computer modeling capability has improved greatly since in the 30 years since then. A few years ago, Congress actually allocated some additional funding for all the FEMA regions around the country to do a comprehensive update of their coastal flood maps. So that's one of the areas that I'm also responsible for, is our California coastal mapping update. It's a long process. It's a very complex method that we have to use to get enough data together to analyze what we think the 100-year flood risk is along the coast. We have a good method. We have good teams working on it. But we purposely put off Southern California to the second phase of that process. It's the most populated part of the coast. We want to make sure we had all the bugs worked out of our mapping process before we tackled Southern California. So for Santa Barbara, we're still looking out a couple of years before we have the first results from that restudy of the California coast that we'll be in a position to share with the county and the communities along the coast. And from that point, it'll be another year and a half or so before we actually finalize and update and completely update the maps along the coast. I don't know yet, because we're so early in the process for Santa Barbara, I don't know yet how significant the changes will be from the maps that are currently in effect along the Santa Barbara coast, but we'll be working closely with the county and the communities all along the way with that process to keep them updated. Tom? I had a question here in the front, but do you want to hold that till later?
Hold it till later if that's okay. Thank you, Ed. I might also mention, Ed mentioned the map modernization of the flood maps, making them digital. You can actually go to the County Public Works website, go to the Water Resources Division, and then you'll actually see a lookup tool where you can put your address in, and it'll show you whether you're in those flood zones, because it's all based on a GIS type system, so you can do that as well, just if you're curious. The other thing I wanted to mention too is Ed mentioned that all the communities, to become a participant in the flood insurance program, have to adopt ordinances that require new development to meet certain standards. And I think certainly the county and most of the cities in the county have adopted regulations that go well beyond what FEMA's bare minimum is, and so that's obviously an important element as well. So now Edie is going to give us a PowerPoint presentation on the Bigger Waters Act, which is really going to talk about the impacts of the cost of flood insurance. And how many slides are on your PowerPoint? 30 slides. So I wanted to mention that this workshop is being recorded by our county television station, and will be available to, you can refer back and look at this again. So if you want to just listen and not take detailed notes, you can always get back and watch this whole program again, either on our government access TV or online. We'll have this posted at our website. We'll make it available to the cities as well for them to post it on their websites. So we'll have Edie come up, and she can start talking about the Bigger Waters Act.
Thank you. Good afternoon, everybody. It's a pleasure to be here in Santa Barbara, and my name again is Edie Lohman, and I work with Patricia, who's sitting in the back, and Ed, who did the National Flood Insurance Program introduction for us a few minutes ago. And I am the flood insurance specialist, and so I get all the flood insurance questions, Ed gets all the mapping and engineering questions, and Patricia's the planner, so all the planning and ordinance questions and building regulation questions go to her. And as Tom mentioned, we will have ample time for questions and answers, and we hope that we can address all of your concerns and questions today. My focus is going to be to tell you a little bit in as simple a terms as I can about the new, what we're calling the new Biggert Waters Flood Insurance Reform Act of 2012, which you'll hear me refer to from this point forward as BW 12. So with that, we'll go to the next slide if we could. Okay, so essentially, what does the Biggert Waters Flood Insurance Reform Act do? First and foremost, it reauthorizes the National Flood Insurance Program for another 5 years through September 30 of 2013. And that's important because this program, as Ed mentioned, is authorized by Congress, and it is administered by FEMA, the Federal Emergency Management Agency, which is us. So we take our marching orders from Congress with respect to the National Flood Insurance Program. And when the program was introduced, it was introduced as a self-funded program back in 1968. So that meant it was designed to have all of the policy premiums that were collected support the operation and the administration of the entire program, so that it wasn't reliant on taxpayer dollars. And so that's an important thing to keep in the back of your minds. This piece of legislation was signed July 6 of 2012, and that is a key date that you also want to keep in the back of your mind, because I'm going to go back and refer to that in the next few slides. Next slide, please. Okay, so why are we making these changes with the National Flood Insurance Program? This program has a long history, but I'd like to stop at this point and take 5 or 10 minutes and kind of give you a brief overview, in addition to what Ed told you about how the program operates. When it was introduced in 1968, it was a voluntary program, which meant that folks could choose to buy flood insurance or not. And we had at least one named storm that comes to my mind in 1972, Hurricane Agnes, along the eastern seaboard. And what we discovered is that the National Flood Insurance Program actually only paid 1% of those damages, which was a very small amount. So the taxpayers picked up the rest of the damage. And so Congress went back to the drawing board and they said, wait a minute, we introduced this program as an alternative to federal disaster assistance, and doesn't appear that people either know about the program or they're taking advantage of the program. And we are spending a lot of money producing maps and doing studies across the country to know where the high risk, the moderate risk, and the low risk areas are. And we've taken the time and resources to put them on a map. So in 1973, they passed the Flood Disaster Protection Act, which was subsequently amended with the National Flood Insurance Reform Act in 1994, and again in 2004. And what the Flood Disaster Protection Act of 1973 said was, if you have a federally backed loan on a structure, whether it's commercial or residential, located in a high risk or special flood hazard area that Ed referred to, and these are those areas identified on FEMA flood insurance rate maps as flood zones A as in Adam or V as in Victor. Those are what we define as the special flood hazard areas or the high risk areas. If you have a federally backed loan on a structure in one of those A or V zones, flood insurance is mandatory if you have a federally backed loan, because we know that this is a high-risk area. We've mapped it, and we know the risk exists, and it's for the protection of federally backed loans. So that's initially how the program got started. And fast forward to about 2005, and this program, the National Flood Insurance Program, although it was intended to be a self-funded program, it does have borrowing authority from the U.S. Treasury, but they have to pay the money back with interest. That's how it's set up. So we have dipped into the borrowing authority for the National Flood Insurance Program back in the early 80s for the Midwest floods. The money was repaid a short time after that, and we've had subsequent incidences off and on where we have had to borrow money from the U.S. Treasury and pay it back. Fast forward to 2005, and we all know what happened in 2005, right? We had hurricanes Rita, Katrina, Wilma, and essentially, I don't think it's any secret that these losses for those events alone were greater than all the losses we have paid in the whole history of the National Flood Insurance Program. And we had to borrow money, and we are currently in debt as a result of that with the National Flood Insurance Program. Fast forward to this time last year, or October of 2012, and along comes Superstorm Sandy, which has further indebted the program, and we've had to borrow more money from the U.S. Treasury to pay the claims. So all said and done, we're $24 billion in debt, and there is no, there's really no resolution to how the program would be able to pay that kind of money back. And probably about 10 years ago, or maybe right around the time of little before 2005, when Katrina, Wilma, and Rita hit, it became very clear, for a lot of reasons, that the flood insurance program was seeing an increasing frequency of flooding across the nation, and the severity of the flooding was increasing. And that subject probably is better for Ed to address, but I can say, you know, changing weather patterns, sea level rise, and a number of other things, not to mention people, the populations moving more towards the coastline and other water sources. So, so we've seen an increase in the severity of the flooding and the consequences. And that's when the conversations in Congress began, really, about, okay, how are we going to keep the National Flood Insurance Program solvent? And it is a difficult question, and there's not an easy answer, there's not an easy resolution, and Congress is struggling with how do we keep the program solvent without costing the taxpayers a lot of money. Because when people are not insured for any type of loss, who pays? Who pays for that? The taxpayers. It becomes a taxpayer bill is what happens. And the thing about disaster assistance is, for federal disaster assistance to be available, it has to be a federally declared disaster. And we maybe could argue the statistics, but I think it's fair to say that about 90% of the flooding events are not federally declared. So it's flooding somewhere all the time. We might not hear about it because it doesn't make the national news or it doesn't make the local news. But even here in California, even in Southern California, I think there's a song about it never rains in California. Not true. Every time it rains here, somebody is flooding somewhere. You just may not hear about it on the national news. So that's really the bottom line. So federal disaster assistance, if it's not federally declared and property owners do not have insurance to cover the loss, then it is incumbent upon them to find a personal savings account source of their own through their personal savings, loan money, get money from a friend, go to a bank and get a private loan to make the repairs. If it's a big enough disaster, and it is presidentially declared, federal disaster assistance is available. However, federal disaster assistance is limited. It's limited to individual and household grants, which you have to qualify for, and it's limited to Small Business Administration loans for those of us that are property owners. So a Small Business Administration loan is a loan. So not only do you have to qualify for that loan, you also have to pay that loan back. So let's say you have somebody who's not insured for whatever peril it is that damaged their home, and it is a federally declared disaster. So now this person is applying for federal disaster assistance, which is taxpayer dollars, and the federal disaster assistance, for them, they qualify for a loan. Fabulous, that's great, except for now they have a Small Business Administration loan that they have to pay back for a house that they can't live in, but they still have a mortgage to pay, so they have to pay the mortgage. And then on top of that, they have a family that they have to find another place to live, whether it's with a relative or maybe they might have to pay rent. This is devastating. This is really devastating, and this is the piece that a lot of people aren't aware of as far as how the disaster assistance works. And this is what I do. When I'm not here, I'm out at a disaster trying to help the disaster victims figure out what are their options. And so I get to see this firsthand, and that's how it is heartbreaking every time I work one of these disasters, because people do not understand how the disaster assistance works. So back to the National Flood Insurance Program. And as Ed mentioned, private flood insurance is limited, and it is still limited. And it was limited when the program was introduced, which, as Ed mentioned, was one of the reasons why they introduced the program to begin with. We're no further along, really, except the Biggert-Waters legislation does encourage private insurance carriers to come into the flood business and to start offering flood insurance more than they have been. We have seen them over the last 2 or 3 decades come in and out of the flood insurance business. They come in and they may offer coverage selectively in this area for this many homes, or they may only want to feel like they can take on the risk actuarially for the low to moderate risk homes, but not the high risk homes. So it's the coverage offered for flood through the private market has been very selective. So the Biggert-Waters legislation, that is one provision in there. They're strongly encouraging private industry to take a look at the market. The technology's better. The ability to identify the risks is much improved since the program originated. We don't know what's going to happen in that arena. That would be a good thing. But in the meantime, the National Flood Insurance Program really still is the only game in town for people to avail themselves to protect themselves against the peril of flooding, other than disaster assistance, and only if it's in a federally declared disaster for most types of disaster assistance, which, again, as I just explained, is really limited. So that's kind of the quandary that prompted Congress to look at the flood insurance program and pass the Biggert-Waters Flood Insurance Reform Act of 2012. Next slide. There are really 3 main sections to the Biggert-Waters legislation. Although the flood insurance sections are getting the most attention, I feel it's worthwhile to mention that there are at least 18 sections that deal with how do we reduce the risk and what kind of studies can we do, like affordability studies, to see what the threshold is for the average property owner and their ability to purchase and maintain flood insurance. Studies on how do we get the grant money out to the local communities and out to the property owners more quickly and in a more streamlined process so that we can get people out of harm's way, because the primary goal of the program is the preservation of lives and property. The idea is not to make the insurance premiums so high that people can't afford them and they can't protect themselves, because that is just a fallback to a taxpayer bailout, which is what Congress is really trying to avoid long term. So there's a number of studies going on, a number of changes to the mitigation and the grant programs that we have available out there to make it more streamlined and easier for people to get a hold of money to help get them out of harm's way. There are at least 13 sections that deal with the flood insurance rate maps and the risk map program, how we do the mapping, how can we make it more accurate, how can we use the best resources that we have. Congress has appropriated a lot of money toward that, because as Ed pointed out, the flood insurance rate maps identify where the risks are, and we use those maps to base our flood insurance premiums. So they are really very important, and we want to have them accurate because we want people to know what their flood risk is, and we want them to have the best information so that they can make the best decisions. Then we have the flood insurance pieces. There are 18 provisions in the Biggert-Waters legislation that addresses flood insurance and how can we make the program more actuarially sound. Of those 18 sections, there are 2 that are currently being addressed, and you will hear them referred to as Section 205 and Section 207. And those are the 2 sections that I'm going to focus on as we move forward from this slide, because the other sections are still under evaluation. In fact, Section 207 is still being evaluated. So we're going to talk mainly today about Section 205, which we began to implement in January of 2013. Next slide. But there's a distinction between Section 205 and 207 that I kind of want to go over at the beginning before we get into the details of Section 205. And there's a lot of information on this slide. Section 205, in a nutshell, deals with how are we going to make the rates actuarially sound? And there's a little story behind that, which I'll tell you in a minute. But Section 207, this is probably going to be the last time that you'll hear me talk about Section 207 till we get to the end of the presentation, because Section 207 is not currently being implemented. It's targeted for the end of 2014, but it's still being looked at by Congress right now. And that section has to do with what should we do with properties that are newly mapped into a floodplain and to accurately reflect their risk as far as their flood insurance premium. So they are still looking at that, and that really has to do with some terms that some of you may or may not be familiar with, called grandfathering and preferred risk policies. This program in the past has done 2 things. It has offered subsidies on older buildings in high-risk areas, which is part of Section 205 that we'll talk about a little more in a minute. Section 207 has its own set of discounts wherein the way we have operated the program in the past is when a property owner has gone from a low to a moderate risk area into a high risk area or a special flood hazard area, we have offered discounts so that we can keep them covered and keep them safe, keep their property safe, and not have them pay the full risk rate for the new flood zone that they are actually in when the map changes. So there are two types of discounts. So 207 still being evaluated down the road. Again, that has to do with how are we going to rate policies for properties that have had a change in their flood zone, and now it's maybe a more hazardous flood zone. And how are we going to deal with the discounts that we have afforded in the past that we can no longer afford to support in the program? Back to Section 205. Section 205 is looking at what we are calling subsidized flood insurance rates. And when this program was originally set up, we had what are called subsidized rates for older buildings that are in these special flood hazard areas or high-risk areas. And it was set up that way because, again, Congress was interested in making sure that where we could identify those properties at high risk, that they have flood insurance coverage, but to also make the coverage affordable. So they agreed that if it was an older building that was constructed before the community had, had its regulations and its first FEMA flood insurance rate map, where they had identified where the high risks were, that they would subsidize out of the revenue of the program these older buildings in high-risk areas. So the program just forfeited those revenues. Unfortunately, at this point, we can no longer afford to subsidize those policies, and they were subsidized to the tune of 60 to 65%, which means that the rates charged for these, what we call pre-firm, and these are structures built pre, means before, flood insurance rate map is what firm stands for. So pre-firm means they were built before their community had a FEMA flood insurance rate map and had identified where these high risk, low risk, and moderate risk are. And so we subsidize those premiums somewhere between 60 and 65%. And that has continued through the program's 45-year history. So Section 205 is looking at those subsidies very specifically, saying how can we keep the program solvent and balance these subsidies that we have afforded in the past. Okay, next slide. So let's talk about, since Section 205 is what is currently being implemented, I want to share with you some details of exactly how it's being implemented and such. But I do want you to know that the Biggert-Waters legislation is very specific. So it is a piece of federal legislation that in it identifies which structures are targeted and what the timeline is and what the decrease in the subsidy exactly is going to be. So next slide, please. So beginning January 1st of 2013, we began, FEMA was charged with phasing out the subsidies on any older structure, and by older, I call that pre-firm, which again means prior to the community's first flood insurance rate map. So any pre-firm, non-primary residence located in a high-risk area. And high-risk area, or special flood hazard area, which is what SFHA stands for, special flood hazard area, those are the A and the V zones. So any A zone, any V zone, and D, as in David, flood zone. So beginning January 1st, any pre-firm, non-primary residence in a special flood hazard area had a 25% rate increase. And they will incur a 25% rate increase over the next few years until they get to their full risk rate. In other words, until their subsidy is not there anymore, and they're actually paying the risk that is reflected for the flood zone that they're in. And we'll talk a little bit more about full risk rates in a minute. Next slide. So again, pre-firm is an older building that is constructed prior to the community's first flood insurance rate map, and assuming it has not been substantially improved or damaged. A non-primary residence is considered to be any residential building where the insured does not live at least 80%, insured or the insured spouse, at least 80% of the time. So this, we're talking about vacation homes, second homes, rental homes. So those 25% rate increases went into effect for that category of structure, pre-firm, non-primary residences in special flood hazard areas, January 1st of 2013, and they will see another 25% rate increase in that category of structure January 1st of 2014 as their policies renew. Okay, next slide, please. October 1st of 2013, 25% rate increases were also afforded to older pre-firm or pre-firm, I use those terms synonymously, business properties that are in special flood hazard areas or D zones, and also what we call 1 to 4 family severe repetitive loss structures, and properties where the cumulative National Flood Insurance Program claim payments have actually equaled or exceeded the structure's fair market value. Next slide. So we define a business property as what you would think a business property would be. This is a non-residential building that is an income producing building, typically designed for office use, retail, wholesale, hospitality, and we are identifying those now on, we capture the business properties on the flood insurance application. Okay, next slide, please. And a severe repetitive loss building is any building that has incurred 2 losses within a 10-year period that exceeds the market value of the building, or has had 4 or more claims over $5,000 each in a 10-year period. That's what we would define as a 1 to 4 family. Well, that's a severe repetitive loss building. Next slide, please. Okay, also October 1st, as part of Section 205, in addition to the 25% rate increases for the pre-firm non-primary residences that began January 1, and then added to that the 1 to 4 family severe repetitive loss properties and the business properties that incurred the 25% rate increases October 1, we have a third category, or a third bucket here, or maybe you want to say a second bucket. One bucket is the 25% rate increases. The second bucket would be these folks. And so these rate increases apply to any pre-firm structure in a special flood hazard area or a flood zone D, as in David, where a new policy is picked up on or after July 6th of 2012. There's that important date because that's the date that the Biggert Waters legislation was enacted. Or a new policy is issued on or after that date, or there's been a policy lapse after October 4th of 2012, and the property owner subsequently wants to pick up another policy, or after refusal of some type of mitigation offer to improve the risk at that particular property. And so when I say that full risk rates apply immediately, what that means is if that trigger exists where there's a new policy purchased, or there's a lapse in coverage, or there is a property sold and it's picked up by a new property owner and they are going to get flood insurance after the enactment of Biggert Waters on July 6th of 2012, then they will see full risk rates. And full risk rates mean that the structure is going to be rated based on its actual risk on the current flood insurance rate map. Now this applies to the structures that are in special flood hazard areas and flood zone D. These pre-firm buildings have been, again, getting subsidized premiums. Newer structures that were built after the community had its first flood insurance rate map, after they knew where the risks were, after they started regulating building construction, those are not subsidized rates. Those structures are already paying actuarial or full risk rates. So they're already paying their full risk based on the map under which they were originally constructed. They are not subsidized like this category. So it is the older buildings in the special flood hazard areas in Zone D that are the subsidized policies. Next slide. Okay, so this is an important slide because it's been out broadly in the news about the Biggert Waters legislation. And so when we say full risk rates, what does that mean in terms of dollars that it's going to cost for those of us that are property owners that have these older buildings that are in high risk areas or flood zone D? And as Ed pointed out in the introduction, for the high risk areas, the A zones and the V zones, for the most part, with a few exceptions, we know how deep the water is going to get. We know what the base flood elevation is. So Ed has, when he does a map, he studies whether the water is going to get up to my knees or whether it's going to be over my head and in a base flood, or what you might want to call a 1% annual chance flood. So we can tell you how deep the water is going to get. And so once the community has that map, when developers and contractors come in to get permits to put new developments in or build new structures or do major improvements to existing buildings, Mike is going to pull out the flood insurance rate map and he's going to say, okay, so you're proposing to build this development in a special flood hazard area or high risk area, and we know, because we have studied this area with FEMA, that the water is going to get to 10 feet or whatever it is, and I'm just pulling that number out of the air. So Mike says to the contractor, the developer, well, you know, if you want to build here, you have to build compliant, which means that you cannot build below, you cannot build the lowest floor elevation where people are going to be living and sleeping below the level that we know it's going to flood to in a base flood, because it doesn't make any sense. If we know the water is going to get 10 feet deep. We do not want to issue permits to allow people to build at a 1-foot elevation when we know that they're going to be, in a big flood, they're going to be flushed right out the door, and probably there will be a lot of dead bodies going down the street. So the higher a structure is elevated above the level that we expect it to flood to, which in the floody world we call base flood elevation, and we have the base flood elevation on the flood insurance rate maps. It's identified on the flood insurance rate maps in the special flood hazard areas. The higher your house or your building is elevated above that level, the less risk you are to flooding, and therefore the cheaper your flood insurance premium. Because even in the real world of insurance, your premium is based on your risk. And I'll give you a perfect example. I have 2 teenagers driving, God help me. So my insurance company did not call me and say, we're going to give you a discount because you have 2 teenagers driving. Didn't happen. My insurance premiums went way up because I have 2 teenagers driving. They're inexperienced, and there's a much higher risk. So we're paying the premiums for that. So flood insurance works very similarly to that. So you can see from this example, and this is just a standard example that we like to show, that if your house is 3 feet above the level we're expecting it to flood to, you might pay $427 a year for the maximum coverage. But if you go over to the far left, you can see on the screen that a house that is 4 feet below the level that we expect it to flood to, or the base flood elevation, might pay a premium as high as $9,500 a year because they are more at risk. And we know through loss statistics and actuarial modeling that structures that are built compliant are 82% less likely to flood. And if they do flood, they sustain 25% less damage. So we collect those statistics, and so we know that. So the idea behind Biggert Waters, in addition to trying to make the program more solvent for future generations so that people have flood insurance available to them as an alternative to disaster assistance, the second piece of this is to keep people safe, to get them out of harm's way. Because we know if we can move them out of harm's way, if we can elevate them, if we can do some kind of mitigation, we know that they're going to be okay, most likely. And if they do have damages, it's going to be significantly less. Next slide. So a lot of people are asking me, well, what if I'm in the category where all of a sudden they're going to full risk rate me because I'm picking up a new policy after July 6, or I sold my property and the new owner is going to be faced with full risk because it's an older building, it's in a special flood hazard area, or what if I just let my policy lapse because I didn't have a mortgage on it originally, or for years I paid the mortgage off, but now I'm going back to get a line of credit because I have 2 teenagers going to college, then I am going to incur these added costs. Well, if a property owner has a flood insurance policy that falls into that category, and they were able to get the policy in place between July 6 and October 1st, when we were required to make this effective, then they will get a notification from their insurance agent / insurance carrier, because private insurance companies are partnered with the National Flood Insurance Program to administer these policies. So FEMA does not do the administration directly. We have the Allstates, the farmers, the CSAAs out there. They are the ones who are administering the policies on behalf of the flood insurance program. They partner with us to get the policy out to the property owners. So we are sending notifications out, and we are letting property owners know that this is part of the Bigger Waters legislation, and that they have an opportunity to go and get an elevation certificate, which an elevation certificate is how we determine on our buildings that are in special flood hazard areas where their lowest floor is in relation to where we expect it to flood to. So a surveyor or an engineer is typically the person who will fill out an elevation certificate, and that elevation certificate will document where the lowest floor elevation is on that structure in relation to the level we're expecting it to flood to, or the base flood elevation. So this notice will provide property owners with at least 60 days notice to get an elevation certificate and provide it to their insurance agent so they can see exactly where their lowest floor is in relation to the base flood elevation. And honestly, although I'm hearing a lot of bad things out in the media, not true necessarily. 50% of the people who have older buildings in high-risk areas who get elevation certificates are finding out that their premium is actually cheaper than the subsidized premium that they have been paying historically. But we also have 50% of the people over here who, when they get an elevation certificate, are finding out that their lowest floor is below the level we're expecting it to flood to on the current flood insurance rate map. Therefore, their premium is higher than what they had been paying in the past. And can we tell you what your premium's going to be ahead of time? Not without the elevation certificate, because we're moving towards a more actuarial rating in this program, rather than the subsidies and the discounts that we've afforded in the past. Yes, sir?
So I have a question in regards to the elevation certificate, because there's a cost associated with that, with the surveyors that they're hiring to do these, and from what I understand, is to do.
Can I give you the mic? Sorry to do that to you, Troy, but you can do it.
So the question is that there is a cost associated with the elevation certificate, with the surveyor or the engineer that they're hiring to perform that. And so from what I understand, there is some leeway where they can actually do the elevation certificate on their own if they have that guidance or direction to do so. But is that information in that notification, and is that elevation certificate just as good as anything that they would hire a surveyor for?
Thank you. I love that question, because if we were doing an agent workshop, this is a perfect forum. But there are actually 2 flood zones, as Troy mentioned, where property owners, for insurance rating purposes only, have the option of completing the elevation certificate themselves rather than hiring a surveyor or an engineer. And without getting into the weeds too much, those would be the unnumbered A zones, where we have no base flood elevation on the FEMA flood insurance rate map, or in what's called an AO flood zone. So those 2 flood zones, unnumbered A, where there is no base flood elevation, so we have not studied in detail how deep the water is going to get. It's not on the map. And in an AO zone, where the depths of flooding are only generally from 1 to 3 feet. property owners can fill out the elevation certificate themselves and provide that to their insurance agent to meet this full risk rating requirement. And that's important to know that. So, next slide. Thank you, Troy. Okay, so I just want to give you kind of an example of how this gets phased in. The full risk rating will be phased in. So we know that the Bigger Waters 12 legislation passed on July 6 of 2012. And let's say I bought a older pre-firm house in a special flood hazard area shortly thereafter. I bought it August 1st of 2012. And now when I originally bought the policy on August 1st of 2012, I was still eligible for the subsidized rate because the subsidized rate did not go away until October 1st of 2013. So now my policy renews August 1st of 2013. I renew the policy at the subsidized rate. Again, because it's before October 1st of 2013 when we implemented the full risk rating. But now, and we can't see this very well on the slide, but now my policy comes up the following year, August 1st of 2014, after the full risk rating requirement was implemented. And at that point, that's when 60 days prior to that, I'm going to get a notification from my insurance company / insurance agent saying that the structure needs to be full risk rated and that an elevation certificate would be required to do that. Click again, please. Okay, so now let's say that in a situation where we have a new policy purchase, we have a new pre-firm policy that's, again, for a pre-firm older home in a special flood hazard area or Zone D. But let's say November 30th of 2012. So before October 1st of 2013 when the full risk rates were implemented. Okay, go in. So on October 2nd of 2013, which is one day after the full risk rates were implemented, I get a notice saying, okay, I need to get an elevation certificate to get this structure renewed because it falls under one of these triggers. Click one more time. And then the policy renews on November 30th, 2013 at the full risk rates. So I think what I really want to get across on this particular slide is that the full risk rate requirement for the older buildings in special flood hazard areas where a new policy was issued or a policy lapsed after enactment of the act began October 1st of 2013. Next slide. Yes. What do I mean when I say lapse? Lapse means that you dropped the policy altogether. You didn't want it anymore, so you dropped it sometime after October 4th of 2012. Why did they pick October 4th of 2012 in the legislation? I don't know, but that's the specific date. So then if you dropped your policy October 4th of 2012, and you picked up a policy between October 4th of October 5th, let's say, and before October 1st of 2013, when we required the full risk rating, you would have been able to renew it as a subsidized policy. But when it comes up for renewal the following year, which is going to be after October 1st of 2013, when we actually required the changeover to full risk rating for that structure, then you'll be notified that you need to get the full risk rating. So I guess the key date that I want people to remember is that the full risk rating really began October 1st of 2013. So if you had a policy out there before October 1st of 2013, when it comes up for renewal after October 1st of 2013, that's when you may get a notice if it's an older building in a special flood hazard area and the policy and it's any type of a new policy because of a lapse or a property sale, then you'll get a notice. Patricia.
Could you please explain the difference between a lapsed policy and a renewal policy?
Okay, so and I think that was his question, a lapse policy and a renewal. So a renewal policy is, and probably I may have confused you by the terms I'm using. Renewal is you're renewing it every year, right? It hasn't lapsed, so you've had continuous coverage. The lapse is when there was a gap in coverage. Okay.
Renewing it every year it occurs. When does that full rate recovery become better?
Great question. So you have your pre-firm structure, it's in a special flood hazard area, you have had coverage, you continuously renew it. When does the full risk rating kick in? Is that what you, okay, it does not. So until it does not trigger until you sell that property or you let the policy lapse. Great question, thank you. Okay, next slide. Okay, so early on when we started, I mentioned that Section 207 was the section in the Biggert Waters legislation that will be coming up next. It is still under review. And for that reason, I don't want to spend a lot of time on it because what I tell you today could change tomorrow, literally. But this section, as I mentioned, has to do with the phasing out of the discounts that we have afforded in the past when property owners have moved from a low to moderate risk flood zone into a high risk area where flood insurance is mandatory if you have a federally backed mortgage. In the Biggert Waters legislation, the provision under Section 207 says that when that occurs, that you basically need to be rated using the current map in effect. And the proposal is to phase that in over a 5-year period at 20% rate increases per year. So this is all I can share with you today on this piece because, as I mentioned, it's still being looked at by Congress. So we don't expect to see anything on this as far as actual implementation until the latter part of 2014, maybe even later, or there may even be some modifications to this. Next slide. Okay, so everyone wants to know how many people, what's the percentage of people that are really impacted by the Biggert Waters legislation, and this accounts for Section 205. And this is the section, of course, that we just talked about where there will be 25% rate increases for the older homes or the pre-firm homes that are in special flood hazard areas. And so in California, that represents about 19% of our policy base here. Next slide. To break that down, we currently have, as of December 31st of 2012, 256,836 policies. So 5% of those policies will be seeing 25% rate increases that began to be implemented January 1. That 5% is broken down by 3%, which are the older vacation homes, rentals, second homes that are in special flood hazard areas or flood zone D, and 2% of those are either older businesses or 1 to 4 family severe repetitive loss properties. 95% are unaffected altogether by Section 205, of the Biggert Waters legislation, except if they sell the property or they let the policy lapse. And out of that 95%, about 14% fall into that pre-firm special flood hazard area category. So of the 95% that won't be affected unless they pick up a new policy or they let their policy lapse, 14% of them could be subject to those triggers out of that 95%. Next slide. So a lot of folks want to know, well, you know, how is my particular community impacted? We have a fabulous website that our GIS folks did that is at the website that you see on the screen. And this is a public website, and you can go on the website, and I assume if I can figure it out, then you all will be way ahead of me in being able to figure out how the map works. But it go to the next slide. It actually will break down the number of subsidized policies. Yes. I'm going to tell you an easier way to get to that. So hang on for just a second. So it breaks down in quite a bit of detail the specifics by county and community of who's being impacted by Section 205 of the Biggert Waters legislation. Go, next slide. Okay, so just to summarize Section 205, and I think I probably beat you guys to death with this already, but just to make sure that we're clear, Section 205 is addressing the subsidies that have existed on the pre-firm older buildings that are identified as being in special flood hazard areas, which are all the A zones and all the V zones and D zones, as in David. And so there is a 25% rate increase that is going to be phased in that began January 1 of 2013 for non-primary residences, severe repetitive loss, 1 to 4 family severe repetitive loss buildings, and for non-residential or business structures. And then we have our second bucket, which is those pre-firm properties in special flood hazard areas or D zones that will be required to be full risk rated after October 1st of 2013 because they're picking up a new policy, or the policy has lapsed, or because they've refused an offer of mitigation. Next slide. Okay, and next slide. Go ahead and, okay. So a lot of folks want to know, so what can I do to mitigate any increases that I might see? We are doing a lot of outreach and education on the Biggert Waters Reform Act. A lot of communities, and this was mentioned by Tom or in the introduction earlier, they belong to what's called the Community Rating System, which is CRS, and that's what you see on the first bullet point on the screen. Community rating system communities do more than the minimum required to regulate building construction and ordinances, and they earn a certain number of credits for doing that, which put them in classifications anywhere from 1 to 10. And if a community earns enough credit to be in, let's say, a class 5, then all policyholders that are in special flood hazard areas are eligible for 25% discounts on their flood insurance premium annually. And if they're not in a special flood hazard area, they're still eligible for a 10% discount if they're a class 6 or better. And Santa Barbara is a class 6, yay. And we have Ventura County here, which is also class 6. So hats off to the community officials and the elected officials here in California, because I and Ed and Patricia can attest to that. We work with a lot of other regions, and I feel fortunate to be in Region 9 because I have known Mike since I was a baby. And so, so he knows what he's doing, is my point. And we have a lot of, we have a lot of experienced staff in the field, and the community officials are very proactive here in California, and they have elected officials who stand behind them, which is great. And you need the two to be able to do the CRS. So it's a good thing. We are encouraging more communities to join CRS. And it accounts for a pretty large percentage of our policy base here in California. So we also are encouraging the communities to be aware of any type of mitigation grants or opportunities. And we're out there trying to help people use mitigation options, use venting or elevation, anything that we can to try and get them high and dry, because we really, really want to see people be safe, and we really want to keep the program going and growing. So that's really the goal. Next slide, please. So there are some resources that I want to make you aware of. The map with all the statistics on it is available if you go to www.floodsmart.gov. So it's www.floodsmart, all one word, .gov, G-O-V. There is a wealth of information on there, but right on their home page, they have a big section on the Biggert Waters legislation, and it will take you to FEMA's public-facing Biggert Waters website, which I believe is the next slide, where we have a number of resources. We have a section for real estate professionals, we have a section for insurance agents, a section for lenders, a section for community officials, a section for property owners. We have fact sheets, we have Q&As. That is where you will find all of the insurance carrier notices that are going out to the property owners that are impacted by the Biggert Waters legislation. And that's also where you'll find the actual map that I showed you with all the Biggert Waters statistics. So if you just go to www.floodsmart.gov, it's a one-stop shop, and it's easy to navigate that website. Next slide. And as I mentioned, there's a lot of resources both on FloodSmart as well as on FEMA's Biggert Waters website. Some of those, they're constantly being updated, by the way. We're constantly taking your feedback and trying to improve these, streamline them, make them easier to understand. So we'd like to hear what you have to say about those. Next slide. And this is a shot of the community officials section of the floodsmart.gov website. Which for those of you in here that are community officials, there's a lot of resources on there that you really want to take advantage of when you can. Next slide. We now have a brand new community rating system section on there that talks about the community rating system and how communities can join and what it does for property owners and for the community overall. Next slide. And if that's not enough resources, we have more. Our region has a mapping website where we put all of the map changes, and there's also a wealth of other information on there. There are newsletters and mapping information that are very specific to California, Arizona, Nevada, Hawaii, because this is the territory that FEMA Region 9 covers. We also have, which you will find right from floodsmart.gov, the National Flood Insurance Program bulletins that talk about anything that's changing or new with the program. We have also from floodsmart.gov, even though they all have their individual websites, that floodsmart.gov website will take you to all of these resources. We have an elevation certificate section where you can download the most current version of the elevation certificate. You can take a look at the instructions, and you can read a little bit about the elevation certificate. There is also a video that you can review that talks. It's a brief video that gives a high-level understanding of the elevation certificate. We also, on the Biggert-Waters website, we do have videos that provide summaries of the legislation as it stands right now. Next slide. So I'm going to wrap this up so that we can address some of your questions. But really the key takeaways here are, again, the legislation is really intended to keep the program solvent and keep it intact so that it is available to all property owners affordably as an alternative to relying on federal disaster assistance, which is taxpayer dollars. So we are really working very hard in what we call the three-legged stool, the mapping, the risk reduction, and the flood insurance pieces. We're trying to make sure that all the wheels are moving in the same direction because there are three pieces. We want to have people understand what their risk is. We want to have the latest and greatest information available to them so they can make good decisions. We want to educate them about flood insurance as a method of buying down their risk. We want people, first and foremost, to be able to have the resources and the information to build safer, smarter, stronger, and we want to use all the resources at our disposal. We want to talk to the property owners. We want to engage the community officials, the elected officials. We want to hear from everybody that has a stake in this game, how we can move it forward, how we can make it better. We have a lot of expertise and we know we can do it. With that said, the Biggert-Waters legislation, while it was passed July 6 of 2012, Congress has been looking at it in sections since then and evaluating what is in the legislation. There are certain provisions in the legislation that, quite frankly, have been questioned. And so they are looking at those to see what can be done, because we don't want the premiums to go too high, because that is really not going to solve our problems. If it's not affordable, then people are not going to be able to avail themselves to it. That's just that simple. So they're looking at that, and they have been having hearings from Administrator Craig Fugate, who oversees the FEMA program and the National Flood Insurance Program. They've been working with all of the industry organizations to get their input from the insurance agents, the insurers, the floodplain Association of State Floodplain Managers. So all of the experts are trying to, sitting at a round table, looking at this and reviewing it. And we will see what they come up with. There could be some changes, so some of the things that we talked about today could be modified. We're not expecting any changes, though, before the first of next year. Next slide. And this is where you can find me. If you have questions that you would like some assistance with once we leave today's presentation. And Troy, you have a question. Sure. Oh, I'm sorry.
I want to stop here really quick, and I want to announce to Mark in Santa Maria, if you have folks that have questions, if you can get them ready, and we'll take some questions here in Santa Barbara first, and then when I turn to you, if you could have them at the podium to talk, and so we can hear that in just a few minutes. Before we get to the questions, I wanted to, first of all, I really want to thank Edie for coming and doing this. This has just been a wealth of information. I want to let everybody know that this, well, first we're going to take your PowerPoint if we can, and we're going to post it on our website, which is countyofsb.org/PWD. You can just search by Santa Barbara County Public Works Department. And we'll also have this video link on our website as well. I also wanted to mention that when Edie said pre-firm, for the county of Santa Barbara, unincorporated area, March 1979, right? Each city is going to be different. I'm not sure which one for each city, but if you were wondering if you live in the unincorporated county, that's March of 1979. So why don't we go ahead and turn it over to the questions. Maybe what we could do, Edie, is I think this mic is live. You can talk there. And then I'll walk around and hand the microphone to the people who want to ask questions so that we capture them all adequately. So we'll go back here, and then we'll go to there, and then we'll go there. And then Mark and Santa Maria, have your people ready there. And we'll maybe take 3 questions here, and then we'll move to you.
Okay, I have 2 questions. One's real quick, and the other one may not be. The first one that's real quick is on the lapsed policies. There used to be like a 30-day grace period where they could get them reinstated. Is that still valid? I guess it wouldn't really matter anymore because 30 days from October 1st is still past November 1st. So, but was that a possibility that they still had?
Yes, and there's some specific details on that, Troy, so I'd want to go back and review it, but I think where it drops off is the 31st day. I can look that up for you, though.
Okay. And then the other is, without really getting into specifics and singing a sob story about Camarillo, but we have maybe an unusual set of circumstances where a large portion of our properties that are in the flood zone are all pre-firm because we had 37 policies prior to the map revision in 2010, and now we have 5,000. So it's a large percentage, and a lot of those properties were developed under county jurisdiction and then annexed in, or they were developed under provisions where there was no flood zone. So when these hearings or this information is getting back to the legislatures or the people who are making the decisions, I would love an opportunity to share this circumstance and these sets of stories with them about what it is that's affecting Camarillo, because it's a major impact.
Yeah, I think Patricia has.
I would just like to respond to that a little bit. The structures that were built under the county's jurisdiction when it was unincorporated, those structures would be run off of the county firm date. So if they were pre-firm at the county date, which you said was 79, you said?
Santa Barbara County. We have
Santa Barbara, Ventura.
October 31, 85.
So if those structures were built before October 85, they would be pre-firm. If they were built after that, it would be post-firm, even though the city of Camarillo didn't get their first flood maps until later.
Okay, we'll move over here, and then Steve, and then we'll go to Santa Maria. If you could just say your name too, please.
Steve, thank you. Hi, Edie. I have a question that's probably a little bit outside the scope of your presentation, but I'm a homeowner here in Santa Barbara. My property goes to a creek, part of which is in a Zone A. All of my structures are outside in a Zone X. For the third time in 9 years, I have a lender or insurance company that's requiring me to prove that I don't need flood insurance. The last 2 times it's been fine. This time, it appears it's not. And I was forced to get a policy before they mandated that I get one. So my house is probably 80 feet above the high water mark of that creek and outside. What would be your advice to me? Do I have to go ahead and get a surveyor? Do I have to pay the money, send a LOMA form in, which the guys at the flood department have said, or is there a faster way to remove this from my house?
I'm going to toss that to Ed because he's the expert here with that.
Okay, Ed Curtis.
Thanks. let me just move down, I guess, so I can be on the camera, but, and without knowing your exact circumstances and exactly what creek you're on, I think that's something we could maybe discuss off to the side. FEMA's been aware in conversations with the city about concerns about the maps that went into effect back in 2005 for Santa Barbara County. There was an update in 2012 that carried over some of that same information, and some of it's related to old studies that were done up narrow canyons and boundaries that are inaccurate based on where the stream center line is compared to where the houses are located. We've had a study in progress now for a few years. The study results have been in place now for a while and are actually available through the county, through the city, Santa Barbara City and the county. And we're also in the process now. In fact, we had a meeting this morning to talk about the next step to get the official maps changed to reflect the new study and the more accurate mapping. Without knowing the details, your situation sounds like it could be one of the ones that's going to be resolved by this map change, and you may not have to wait until the final map change goes into effect. Like I said, we could discuss off to the side. There may be a way we can use the available data. What was considered currently available data to go ahead and help you work with your lender on that.
And I think we have some reps from the city of Santa Barbara here as well. So we're going to go one more, and then we'll go to Santa Maria, and then we'll catch you back there.
Thank you. My name is Steve. There are multiple properties in southern Santa Barbara County which are not only pre-firm, but are extremely expensive. And currently, you can get flood insurance up to $250,000. Is there any plan for increasing that? Because in a lot of cases, that wouldn't even get the debris moved.
Right, and that was one of the proposals before they actually enacted the most recent legislation. Unfortunately, I think the actuarial soundness of the program was the primary concern, and as a result of the indebtedness of the program, they weren't really able to increase the amounts of coverage, because we do know that, you know, on the East Coast and on the West Coast, $250,000 for a residential building, which is the most you can buy, is just not cutting it, really. And we have $500,000 for commercial. Now, on the flip side of that, there are some private flood insurance carriers who will offer flood insurance coverage above and beyond the first layer that the NFIP offers. So we do have that, but they're aware of it. Yeah.
Okay, Mark in Santa Maria, do we have any questions?
Coming up. This is the camera's looking at that. This is Steve Devereux. I'm an insurance broker here in Santa Maria, and my question is with the elevation certificates. I have commercial clients where of course, they're obligated to have a flood insurance policy, and just to go to them, recently they've had to go out and pay for the elevation certificates. You know, I'm wondering, why should the consumer absorb these costs? I know the private industry doesn't require it. You have a couple carriers that I use outside of the FEMA program. Why can't FEMA absorb some of these costs, or is there any way that they can offer discounts?
Yeah, that's a really good point. And I think we have not historically required elevation certificates for full risk rating on these pre-firm buildings in special flood hazard areas. We've only done it on the post-firm buildings in special flood hazard areas. So if it's a post-firm building in a special flood hazard area, it's more likely, especially if the community is participating in the community rating system, that they could contact the local floodplain administrator and they'd be able to get a copy of the elevation certificate, or at least pull some data that would make it a little less expensive. However, on these pre-firm buildings, this is a new rating procedure for us. We have not elevation certificate rated them in the past. So we are now in the process of roundtabling. How can we make this less expensive? We know that in those two flood zones that I mentioned, the unnumbered A zone where there's no BFE, or in an AO zone, that property owners can complete the elevation certificate themselves for insurance rating purposes, but it still leaves others with, how do they get an elevation certificate that's not expensive? Some neighborhoods, if they have entire neighborhoods, they have actually hired a surveyor to do what I call a group of elevation certificates and have gotten pretty good group discounts. Some local communities have been able to provide some level of funding for elevation certificates, and that I need the community officials in this room to speak to, because that's out of my area of expertise. So I don't want to get them into something that, they will know more about that. But that's been one proposed option. Otherwise, we're still trying to feel our way through this and figure it out, because we do recognize that some of these elevation certificates can be expensive.
Mark?
Do any of the community officials?
Well, for Santa Barbara County, that's not a program that we, provide our tax dollars to support that. It's just, it's a difficult proposition, doing the things that we need to do as it is, so.
Mike?
Okay, Mike, did you have a comment on that? Yeah.
I have on file in my office over 1,400 elevation certificates for both pre and post-firm structures. Now, I don't have every pre-firm structure, but I do have a lot of them. So before you hire a surveyor, give me a call and see if I've got yours on file. 568-3449.
Okay, Mark, another question up in Santa Maria before we come back here?
That was all the questions up here.
Okay, we had a gentleman in the back here.
There is one more, sorry.
Oh, one more? Okay, go ahead.
Let's see. When you talked about the elevated certificate, does that mean like a building that was built with a basement or two-story, or what is that?
I'm not sure I understand your question. Mike's going to answer here.
An elevation certificate is a form on which a surveyor fills out to show the elevation of the lowest floor and the lowest adjacent grade of the structure.
So that would include basement. It would include the basement, yeah.
Okay, it could include a basement or a two-story building.
Yeah, the lowest floor of that structure.
Okay, thank you. And then the other question was, when you were talking about the pre-firm, and you had talked about grandfathering and businesses and all that, does that include personal residence too?
Yes.
It did?
Yes.
Okay, and then what zone were they included in?
Well, the Bigger Waters Reform Act addresses the older buildings, whether they're commercial or residential, that are in high-risk areas, which are all the A zones and the V zones.
A and the D?
A as in Adam, and V as in Victor, and D as in David.
Okay. And then how do they determine when you have a street and there's several houses on it, and then they just pick out 2 or 3 houses and say that they're in the flood zone?
That's a good question for Ed. Ed is our FEMA Region 9 engineer.
Sure, I'll try to answer that. And there could be a couple situations here. When we develop a flood insurance rate map, first of all, we do a study, an engineering study based on a model. of the area, of the floodplain area, to see how high the water is going to rise during the 1% or the 100-year flood. So that study gives us a water surface or a flood elevation, and then we look at the elevation of all the ground in that area, and any ground that's higher than the flood elevation, we're going to show that as safe from flooding, or it's going to be in the low risk flood zone. And if the ground elevation is below the flood elevation, then it's going to be flooded during the 100-year flood. So those are the houses or the areas that get shown on our maps in the A zones and the V zones. So if we have a street that has some changes in elevation along the street, I mean, it's possible that there could be a couple of houses that are higher on high ground that are shown as not in the flood zone, and then next door there could be a couple of houses that are on lower ground, low spots in the neighborhood, and they'll show up as being in the flood zone. They'll be in the A zone. The higher buildings we would show that as an X zone on our map, and nowadays we use shading, and we use the blue shading color on our map is the high risk A and V zones are all going to be showing up as a blue shaded area. Now, we also do run into a situation where there could be our map could show that every house on that street is in blue shaded, high risk, 1% chance or 100-year flood zone, however you want to call it. But for different circumstances, there may be one or two or more houses that are required by their lenders to have a flood insurance policy, and their next door neighbor may not be required to have a flood insurance policy. And there could be different reasons for that. One obvious reason might be if the owner does not have a mortgage, if they've paid off the house. Then the mandated flood insurance requirement does not apply because they don't have a federally backed loan or mortgage on their house. So there could be some differences along a street about who's required to have a policy, even though all the houses are in high risk flood zone. Is that helpful?
Well, it's kind of helpful because we live where the pond or whatever it is way below us, but yet there's 2 or 3 of us that it has come from the bank that we're required to get a flood zone, but our houses just have an equity loan on it.
That I think, and Edie can help me out here, but she's nodding her head. That even an equity loan falls under the requirement to have a flood policy. So the lender is the one who's requiring the policy, and it's because they've loaned, they're loaning money to you on your house as security.
So is there a way that we could see a map that would show us that we're kind of like not out of that flood zone? We're out of it?
Yes, and you can work with the...
How do I get one?
Well, Mark is there with you in Santa Maria, and he could probably arrange a meeting in our Foster Road office in Santa Maria where you can look at that.
Okay, fine, thank you.
All right, we got it
Thank
back here, and then a couple on the... Wait, hang on. You got to get on the microphone here so everybody can hear you, if you don't mind. Thank you.
This is a little bit nitpicky, but by degrees, the relationship from the base flood elevation and the bottom of, for example, my structure is approximately 5 feet. I was able to get a reduction by providing a proper certificate, and I went from $1,900 a year to $244 a year. Now the question is, 5 feet is 5 feet. How come it's $244? Why isn't it zero? Number one. And the second part of that question would be, is it incremental as it goes up how many feet you are above the base flood elevation? If you've passed all the criteria for your certificate. Is that clear?
Yes, I think if I understand your question correctly, yes, the price goes down as your lowest floor goes up. So you know, the higher you are above the flood elevation, the cheaper the flood insurance premium is going to be.
How do I know what that is?
We measure that on an elevation certificate. For a house that's in a high-risk area or the special flood hazard area, we have identified, or Ed has identified, on the FEMA flood insurance rate map how deep the water is going to get in a base flood. And we compare that difference to your lowest floor, and it's documented on an elevation certificate form, which is in most flood zones completed by an engineer or a surveyor. And then it's provided to your insurance agent, who provides that to the underwriters, who can then take a look at it and see how high you are above the level we expect it to flood to, and then tell you what the premium would be.
And you asked about why doesn't it go to zero? Because your foundation presumably is still in the floodplain and therefore subject to flooding and could be damaged. Now, however, if in the course of the survey it shows that not only the floor of the house is above the floodplain, but the highest adjacent grade just outside of the house, if that also is above the level of floodplain, you can submit that data to FEMA for a letter of map amendment and get out of the flood insurance requirement altogether.
No, that's my question.
No, actually, we have a book about this big that has all of the National Flood Insurance Program rates on it. But for the structures that are full risk rated, the rate categories are based on the lower the risk of flooding, the lower the premium. And that has to do with how high the house is elevated above the level we're expecting it to flood to.
Okay, so we had one back here and then Chris. So you had a question, Chris, too? Okay, so was it you back here? Okay. Thanks. Thank you.
Hi, Edie.
I'm in trouble now.
No, it's fine. It's a two-part question, but both have to do with human error. The first thing is, as a floodplain administrator, we review dozens upon dozens of elevation certificates for all new buildings. And I have probably yet to see one that's done correctly the first time, and a little better percentage the second time. They're usually 2 or 3 rounds before they get them right. And primarily because there are so many measurements that have to be correct. And why is that important? Because it ultimately determines dollar value for insurance. So we pore over them really carefully to make sure they're accurate to the 1/10 of a foot, which is what we're required to do. The thing I'm concerned about with AO zones and proximate A zones is that when homeowners or surveyors complete these, they haven't had the training how to do them, and they submit them into their carrier. And that carrier will take that thick book and come up with a dollar figure. And if those numbers aren't correct because of human error, they're paying a lot more. They could be paying a lot less too, but most likely a lot more. So my question is, on a bigger picture, is there some way down the road that FEMA may want to think about putting all elevation certificates in the hands of the local community officials to review regardless? And maybe make that a series of points, by the way, because once they go out of because as local officials, we don't see them. Mm-hmm. We will not see those ever when they're done for those reasons. And it's a buyer beware at that point. And my second part of human error is we have a situation we talked about where we have somebody that has $1,400 a year for their premium. They purchased their home after July of 12, and they're up to $4,600 a year now. That's that thick book. Is there somewhere in FEMA that people can use as a hotline for checks and balances to make sure that their carrier is calculating it correctly?
Two really good questions, and I would wholeheartedly agree with you on the first about a check point for the elevation certificates prior to them getting to the underwriters. Theoretically, when they get to the underwriting department, they're supposed to be, regardless of what flood zone they're in, they're checking to see that they are good numbers And I think the way that, I'm not an underwriter, so I'm talking a little off the cuff here, but pictures are required. So often what I hear is we'll come back to the insurance agent or the property owner and say, well, you know, the pictures that were sent in with the elevation certificate don't jive with the numbers. So we're thinking that you need to talk to your engineer or surveyor and go over this, because I agree with you. A lot, we do see, and I think Patricia can agree to this, we do see a lot of elevation certificates that maybe aren't completely accurate. Some are, some aren't. It just depends on, you know, the level of experience that that person has had in completing those. So I think it's going to be a bigger issue as we go forward. There are some, you know, like I said, checks and balances on the underwriting side, but it is conceivable that they could be completed incorrectly. I guess the good news from that standpoint is if it's incompleted correctly, regardless of the flood zone, and it generates a big premium, that sends up a huge red flag to the property owner, who then calls Edie Lohman, and Edie Lohman looks at it and says, uh-oh, let me call Patricia, and Patricia and I get together, or whoever, and try and figure out what the problem is, and we can catch that and talk to the surveyor or engineer and get it all straightened out. When it is the opposite way, like in an AO zone where they filled it out and they've done the numbers so that they're in their favor, whether they really are accurate or not, those are likely not to get caught until they have a claim. And then when they have a claim, the adjusters come out, and part of what the adjusters are doing is checking the underwriting file to make sure that we have a structure here that we're accurately insuring based on the data that we have. So it could catch up with them at that point. With regard to your second question about, you know, how do people know whether the flood insurance rate that they are getting or the premium they're getting from their agent is accurate? Well, we don't have a toll-free 1-800 number that property owners can call. However, most of the right-to-own companies have their business serviced by servicers, third parties. And there's a lot of servicers out there servicing the business, but there are 3 or 4 major writers. And so if you go on to the floodsmart.gov website, they have their hotline numbers or toll-free numbers listed by carrier. So you don't need to know who that third party is that is servicing the business for your insurance policy, but if you know that you got the policy written through an Allstate agent and you go to floodsmart.gov, you can get the number for the servicer, and there's a special number that they can call, whether they have a claims question, an underwriting question, or a policy coverage question, and talk to an underwriter or an actuary and say, I have some concerns about my claim or my underwriting, and they'll help them. Yeah.
Okay, Chris?
Thank you. My question's related to the preparation of the firm, the maps. In 2005, I believe, the firm maps were produced for Santa Barbara. As a government representative, we use some of those firm maps for locating specific government facilities, both elevation, laterally, and vertically. We found that some of those elevations, topographic features on the map lines, were off as much as 6 foot vertically, 12 feet horizontally. So that makes a big difference. Now, you mentioned there was going to be some corrections to that. From a watershed standpoint as well, do you consider retention basins, debris basins as part of the analysis for flood zones, floodways, and determining flood elevations, particularly in specific confined watersheds?
Regarding the retention basins, debris basins, we're probably going to, when we do that study or that analysis, we're going to look at what the capacity is based on a 100-year flood event. And if the retention basin isn't designed to provide adequate retention or detention for a 100-year event, it may not have much effect on the downstream flooding, but it's going to be analyzed as part of the study. So if you have a specific question about how we've analyzed a specific reach or stream, I can work with you directly on that. And I know going back to your question about accuracy, and horizontal accuracy is problematic on our flood insurance rate maps because we get into issues with the width of the line because we have a specific line width that we use when we draw the lines that are the boundaries of our flood maps, but at the scale that we print the maps at, that the width of that line itself could be as much as 30 or 40 feet when you look at it in real terms on the ground. So differences by, for me, 12 feet is right on. And I realize that's not, when you're talking about the corner of a house being in or out of a flood zone, that's not right on as far as that property owner is concerned. So when we're made aware of those issues, we try to work with either the individual property owner or the community to see if there is a way to improve the accuracy of a boundary line. A vertical accuracy of 6 feet, that's a real concern because we're talking about when we take our the best available information that we have about ground elevation, channel width, and what have you, and put all that into a model. We expect the model to come out to within at least that 1/10 of a foot accuracy that I think Brian mentioned earlier. So if depending on what you're comparing with, when my map says that the water surface elevation is 35 feet, and if you've got some other source that says that it's 29 feet, and then we're off by 6 feet, then we'd like to find out what you're comparing us to, so we can resolve that.
Thank you. Both those factors would seem to play into developing the floodway, flood zones, as well as affect rates.
Mm-hmm.
So those are, especially if you have retention basins that knock off peak flows and then create the recession curves on a much slower rate. So that would have a significant difference downstream particularly.
And sometimes that gets into a question about whether we're doing a steady or an unsteady, looking at steady
Flood
or unsteady
analysis.
flow. And
Yeah.
typically we've used steady flow, not unsteady flow, where we actually look at the variations in the flood as it comes down, works its way down the stream. So there are various refinements that we can do to our modeling to take into account situations like that.
And you said the firm maps that you're going to be creating in, 2.5 years are going to possibly change some of the anomalies that I've seen on some of the local maps?
Well, there's really two things going on. One is a coastal study that probably won't affect the issues you're looking at, because that's not going to address we're not going to revise any rivers or streams except where they tie in down at the coast. We're not going to go back upstream to restudy any of those streams. We're just going to look at how far during a major storm event along the coast, how far are the waves going to push the floodwaters up along the coast, and how they're going to impact structures and what have you. On the other hand, we have done some new studies over the last few years, mostly within the city of Santa Barbara. A lot of them are on streams like Sycamore Creek, and the branches as you go up into the upper part of that watershed. The results of those studies are going to be issued as new revisions to I think it's a total of 6 panels in the city of Santa Barbara. You'll start to see some outreach and some public information about those here within the next few months. We just had a meeting this morning. I think we're going to go ahead and issue the preliminary versions of those maps here before the end of the year.
So are you the contact individual?
Yes. I've got a card I can give you when we're done.
Want to check into Santa Maria again with Mark? Do we have another question?
Yeah, we have another question.
Okay, and then we had a gentleman. Okay, a lady right there.
Yeah, I wanted to address the young man that had spoken something about the checks and balances of engineers and surveyors. So what is accountability as an maybe unexperienced engineer or survey, and for whatever reason, and when it goes to the underwriter, it could perhaps be incorrect. So how can this be like checked into or investigated where it isn't so costly? Because a friend of mine was talking to a surveyor, and he said, oh, you don't want to do that because it's going to cost you a lot of money. And so how can we get the help without having to pay out a lot of money, because we're already going to have to increase our flood insurance?
Yes, that's a really good question. I think what we advise property owners when they're looking for a surveyor or an engineer is to kind of quiz them a little bit about their experience filling out an elevation certificate. Obviously, if they don't know what an elevation certificate is and they have to ask you twice, that's probably not a good resource. If that person is familiar with the terminology on the elevation certificate and they can give you some referrals of some that they have done for other property owners that you might be able to contact and see how that turned out. That's really good. I mean, we don't want to make this a 2-week research project for you, but certainly it's a big enough cash investment that you do want to be aware that you should shop around and make sure that you're hiring somebody that knows what they're doing.
But doesn't your organization have where we could get some help? Or it's not going to be so costly?
Well, FEMA does not have the authority to be able to make recommendations on surveyors and engineers.
Oh, so there's no really accountability on them?
Well, the underwriters will look at the elevation certificates related to the photographs when they come in, and if there appears to be a problem, then they will definitely contact the insurance agent and the property owner. So you will be put on notification that way, but then it would be, then it would be incumbent upon you, and we can assist in contacting the engineer and surveyor and saying, hey, there seems to be an underwriting discrepancy. Can you help us out with the interpretation and the numbers that you put on the elevation certificate? So we do provide that. We just can't recommend we can't recommend or endorse a specific engineering firm or surveyor firm.
I see. There's no accountability on the underwriter either. Is that correct?
Well, I was going to say, you might want to check with whoever you hire how many elevation certificates they've done, and I think that would be a good indicator of what they could do. We're going to take one more question in Santa Barbara. We've been going at this for over 2 hours, and then we're going to just break, and we have our staff here available for specific questions, as well as Mark up in Santa Maria. So our last question, you had a question, or did they left? Okay, well then we're going to go ahead and wrap this up. I want to thank everybody for taking the time. I want to thank our friends from Ventura County coming up and joining us today. But mostly want to thank our representatives from FEMA, Curtis, Edie, and Patricia, for joining us today. They're a long way from home to be with us today, and we really appreciate that. So thank you, everybody, and we'll be around for questions.